We talk a lot about the critical commodities on our show. Let's go back to basics, the building blocks of our society, literally. Today we have a new guest on the program, Chris Batalha, CEO and director of Oceanic Iron Ore Corp, that's FEO on the TSXV. And Chris is going to be giving an outline as to why investors need to be paying attention to the basics, the foundational building blocks of our economy. Chris, welcome to the show. Good to see you.
Thank you, David.
20 years ago, the case for steel, copper, base metals was the rise of China. Construction of housing, of commercial property and buildings erupted into the world's, at the time, second largest economy, into what people believe will be the world's largest economy by the end of the decade, if not the next decade. Chris, what has changed, if anything, between that narrative and now? Is China still the world's dominant driver of construction demand, which ultimately leads into iron demand and steel demand?
It is, David. As soon as you see some sort of article in the news about a long-term or a medium-term or short-term outlook on construction needs and infrastructure demands in China, it seems to have a corresponding impact on the spot FEO price. But you've got other markets like India who have more aggressive infrastructure demands that are on the horizon of impacting some of the price movements as well. But there is a significant presence of Chinese influence still, correct.
But are we seeing a shift away from housing and infrastructure to more defense, power grids, industrial reshoring, perhaps even AI data centers as the primary source of construction?
I don't know that it's primary, David, but it's having a significant impact on it. And it lends itself to the story of iron ore and why people should be paying attention to iron ore versus other spaces like precious metals. And I get it. Precious metals carry the news. It's sexier and it's had a movement in price over the last couple of years that we don't need to talk about because we all know about. When you look at value creation and your view on commodities, gold, for example, its upside is basically tied to what investors think will happen in the future, and they're always imperfectly correct or perfectly wrong. But iron ore's value is always about what the world needs, not about what investors think. And you haven't found a replacement for infrastructure inputs in place of steel yet. Everybody needs steel. And it's quite believable that there are infrastructure demands in the short and medium and long term as the world grows. And so you've got to take a bit of a view that way as to where the value creation comes from in the iron ore space.
Tell us about iron ore itself. The Strait of Hormuz closure has taught us something very important, which is that economies depend on critical minerals, and equally importantly, they depend on reliable supply chains. And it's got a lot of countries and people around the world rushing to build their own supply chains now that they realize that critical choke points can be cut off at any moment without warning. So where is iron ore produced mostly in the world, and how much is needed?
The primary geographical locations of iron ore production in the world include the Pilbara in Australia, northern Brazil, where the company Vale has a stronghold on most of those deposits. But listen, iron ore generally is around the world. It makes up a significant amount of the Earth's crust. The key is where it's available at surface and can be economically mined and shipped out to a port. Quebec is one of those areas as well. It's got a geological trend called Labrador Trough, where it's got a significant amount of iron ore presence and at surface, and can be economically mined. A lot of it requires rail to get to the port. It brings that up. Our distinct advantage, though, us being oceanic and in northern Quebec, is that we are 25 kilometers from the water, so we don't need rail. And when you're looking at the iron ore industry, your all-in costs are about 50% transportation and logistics, and the rest of it is the actual mining and processing and G&A that comes with operating any other mine. When you cut out the rail component of that, like we could cut out the rail component, we just need to truck it 25 kilometers to the water, you're left with extra margin and the ability to reduce your operating risk, which is what our management team's ethos is all about.
Let's walk through the iron ore chart here to educate the investor audience. This is iron ore US dollars per ton. Going back to 2016, it's climbed about 50%. Before we talk about the long-term drivers and the consistent growth here, what happened in 2021?
You had a blip of. It comes back to one of your earlier questions. You had a blip of infrastructure outlook, and particularly in China, which really drove some of this pricing way up. It wound up normalizing when some of that news normalized, and it comes back to the point of China driving some of the pricing. The key is where was it before, and it goes below before where you've got your chart. When 2023 to 2018, it was in the sort of $40 to $50 range, and that was at the point where you had this super cycle previously with all these miners expanding, given the price of iron ore was up around $150 a ton. And then the Chinese demand for infrastructure just sort of slowed down by the time those mines came online. The point I want to make to your viewers is we're at a point now where not only are we still dependent on China, but less so. You've got noted infrastructure demands that are cast across other jurisdictions like the Middle East, and I'll cite Saudi and UAE as examples, and you have very moderate demand for other infrastructure projects in India and in Japan. The other distinction I want to make on the chart that you brought up, David, is that price is based on a benchmark product of 62% purity. Our product is 66.5% purity, and that's a blast furnace product. Your typical iron ore as being processed into steel is processed through a blast furnace, but that is evolving and migrating to what's called direct reduction iron and processed through shaft furnace and electric arc furnaces. And the reason you're doing that is because it has a significantly lower carbon footprint, and it reduces emissions by a significant amount. And the world is pushing towards lower carbon emissions, with steel production accounting for 8 to 9% of the world's carbon emissions. There's a specific focus on steel being created with green iron ore. And I'm mentioning this because when you get to high purity iron ore, which is what you need for green steel, there is a more finite supply of product in the world. And this benchmark of 62% pricing you're showing isn't applicable to us because we would attract premiums for purities and low impurities for our product.
And your product, by the way, your company based in Quebec with deposits around Quebec, the purity that you're talking about that's required for green steel, so to speak, is that dependent on the geography and the geology of in which you're extracting the ore, or is it something that can be done in the refining process? Explain to us how it works.
No problem. It starts with the head grade and the mineralization of what's in the ground. And you have other jurisdictions who have had high purity iron that can be processed into the critical mineral level, the direct reduction iron. But a lot of it has been mined out in places like Australia and India, so on and so forth. So when you've got something that's not as high grade, you have to beneficiate that product and process it to get to that critical mineral level. In Canada, that is 67% purity of product. We're already at 66.6, but also you have to get your impurities down below a suitable level. They just call it appropriately low. And one of the main impurities is silica. When you're designing for a blast furnace product, the traditional iron ore product that gets into your traditional steel, you design it to anywhere between 4.5% and 6% silica. You're required to do that for the processing. They want that. So we have to additionally process it to get it below 3%. That can't happen with every deposit. And some of those deposits don't have any more head grade to actually get to that 67%. So that's why I keep coming back to this statistic is you're going to be left with a scarce supply of what can be turned into the high purity iron ore. The two main geographical areas that will succeed in this and have resources at volume are in Brazil and in Quebec. There are other areas in the world like Guinea. There's the more recent project that's come online, Simandou, that has the ability to do that. And there are other spots other in the world, but in volume and for decades to come, the main two areas are Brazil and Quebec.
Once the ore is extracted, tell us about the rest of the process, all the way from refining to being used in construction.
No problem. So once you've mined the ore out of the ground, it gets crushed to a suitable level, and that will depend on the type of mineralization your product has. And most of our product, at least the Oceanics, 84% of it can be recovered through one of the simplest processing methods, which is gravity circuit. So you've got these spiral concentrators, and it's the cheapest way of basically separating out the ore from the waste. And then if you need to, which for 16% of our product, we do need to, we would grind it a bit more finer and separate it through what's called low intensity magnetic separation. So usually gravity circuits and magnetic separation are your more traditional paths to processing iron ore. When you get to direct reduction iron ore and you want to get to the high purity critical mineral level, you may have to process a bit more to get rid of the impurities, and that may be done either through more intense magnetic separation, or you may have to use a reverse flotation circuit to get rid of the nasties. And then once you're done, you've produced a product. In our case, we produce a concentrate. There are many different forms you can produce depending on the mine. Once you produce a concentrate, we bring it to the port, and it gets loaded onto, in our case, Cape-size vessels and shipped off to, most likely, steel producers who will then put it through their furnaces to produce their end product. And again, the type of furnaces that they use to produce the steel, which they will add other materials in there as well, will depend if you want the high purity product or not.
I know for copper, for example, China accounts for most of the world's copper refining. Is that the case as well for iron, or is that more localized around the world?
Actual steel production is still heavily done in China. As of a few years ago, it was about 2/3 of the world's steel production. It remains in that level, but it's starting to decrease over time as other markets have infrastructure demands. And as you say, they need to start producing in country or through allied countries to address the risk of conflict in other areas that may have a stronger hold on supply of those products.
Okay. Just give us a sense of how rare this green steel iron is. The high purity iron that you're talking about. We mentioned Quebec, which we'll talk about in a bit more detail in just a bit. But there are a lot of projects around the world that are coming online, and New Guinea is attracting attention. Simandou, as you know, 2 to 4 billion tons estimated resource. And is this a completely different grade that we're looking at here in the case of Simandou? Or are we talking about globally just a surplus of iron ore going to be the case here?
It's a really good question. In terms of the availability of high purity iron ore around the world, as I said, Quebec and Brazil have significant amounts of resource in the ground that can meet that criteria. Simandou has come online. It claims that it will go up to 120 million tons per annum, and it's currently producing a very high grade, but you're more geared to your traditional blast furnace product. Some of the deposit does have the capability of being further processed into direct reduction iron, or the high purity iron, as we talk about for the green steel movement. It remains to be seen whether it will be done or not, but it's possible. Having said that, and given the increased introduction of that reserve into the iron ore supply chain, you have to remember, you get these words on the street about, oh, they'll glut the market because they're going to produce 120 million tons per annum and it doesn't cover what the demand is. I'm not the only one saying this. There's an article by BMO about this as well, and by others. It's simply replacing the current depletion out there in the iron ore production market. So while I could see there being a psychological short-term effect on the iron ore price because it's come online. Once people start to realize, and you do the calculations on all the other producers and what they're producing and what they're depleting, because they're not replacing what they're depleting because they mined out all the good stuff, particularly in Western Australia, you will start to see that it's just replacing reserves. And as the world moves towards green steel production, and they're mandated to, there are countries that are mandated to, they've got to secure that source elsewhere. It's possible in Simandou, but you're left with Brazil, Quebec. Ukraine is another area that has some supply, but you'll find as long as these mandates continue, and the street is saying, everybody in the street is saying that this supply will, or this demand will continue for green steel, you will see a greater disparity in demand over supply for this product.
What makes Quebec unique in this regard? Talking about the geology of your projects. So this is on your website. Ungava Bay Iron Deposits is one of the projects you're focus on. Hope Project, and the company itself is called Oceanic Iron Ore Corp, which alludes to the jurisdiction in which you operate. Tell us about the geology of Quebec, and in particular, the projects that you're focused on, why that area in particular, in relation to the overall thesis of the world needing more green steel.
So I'll touch on the geology, but then I'll also touch on the geography of where we are, both as it relates to logistics and geopolitics. Your typical Sokoman formation in terms of geology, so you've got a very high grade, your head grades are around 30 to 32%. That's before processing. And near surface, that's the other key, is being near surface and having a low strip ratio so you can mine it economically. And we have this geological trend. And in the map you've got there, where Quebec is in green, you've got this light green shaded area in the inset where, that's right, thank you, where that's called the Labrador Trough. And that is the geological trend of voluminous iron ore formation at surface in Quebec. And that's hundreds of kilometers. In scale, it looks like a sliver, but it's hundreds of kilometers and many, many kilometers wide. And so Quebec as a jurisdiction, you've got all these yellow dots that have development projects with iron ore, and the red ones are producers. And there's more than that than indicated in this map. It's a little dated, but where we are, the top 3 yellow dots at Ungava Bay in that sort of tic-tac-toe box. And the primary project area is Hope's Advance, which we're progressing. And the other ones up top are called Roberts Lake and Morgan Lake, which have historical resources. All these deposits, David, they have significant amount of resource, and they are all quality deposits. So when you look at these yellow dots, there's not a lot different in terms of quality and quantity. Where the difference is, and this will be the third time I've saying it, but it is critical and is that important, is all these yellow dots, if they were to be built, they need anywhere from 300 to 700 kilometers to get to a port. And the likely port is a city called Sept-Îles, which is in the bottom right there, labeled in red.
Yeah.
And you have 2 challenges. One, just the sheer cost, CapEx and OpEx of running a rail. And the fact that you've got that cost profile means you have to build really big to justify a payback period. And so you've got projects that have significant capital costs. We're able to build this project at a production profile that's very reasonable for a bulk-based metal project and is financeable at 1.2 billion per our last study. Again, because we don't need the rail. We have friends who are producing in that province who are doing very, very well, and we're big fans of theirs. They have rail costs anywhere from $25 to $40 a ton Canadian, which we just don't have. And I come back to anybody who may be cynical about the long-term outlook price for iron ore. And it's not only about the fact that we're low cost, but it's the fact that we would thrive and survive if there were any downturn in the iron ore price again, which, by the way, I don't foresee, but it should serve as a de-risking factor in our project. And that's been a hallmark for this office space. You haven't been in this office, David, but I've been involved in the mining space for 15 years under Stephen Dean, who most of your viewers will know about. And before we've relaunched Oceanic, he and I were a part of teams called Atlantic Gold and Artemis Gold, who have the hallmark traits of low-cost producer, tier 1 mining jurisdiction, and de-risking the assets more than other assets have been de-risked. And so when coming back to Quebec, you have a tier 1 mining jurisdiction. It's rated whatever it's rated in the Fraser Institute, but it's rated very highly. You have a very resource friendly province and well supported by government. They have funds that are specifically designed to make sure that the natural resources are exploited for the betterment of the economic development of the province. You've got supportive government for it. In fact, they have a division called Société du Plan Nord, which is entirely mandated to make sure that the north of Quebec is economically developed. So we've got, the marks of a de-risked environment that we can execute on.
We've seen massive consolidation over the years, a couple of years in gold and copper spaces. Is iron ore next, you think?
I don't know. I think it stays in precious metals for the next couple of years, only because it's the sexy thing and they want to capitalize on the run that the price has been on. So I see that. I think where it can make sense in the iron ore space is geographic proximity. Could I see someone else with a presence in Quebec want to, and they have the relationships in government to permit the project, that want to just lump on and take on our project as well and contribute to the green steel movement? Yes, I can see that. Another example, a recent example, has been Vale, who have invested in a neighboring asset in province. And that should show you, David, the amount of critical mineral level resource they have in the ground at Brazil, and they're still going elsewhere to go and secure more of that product. And they've gone to Canada, they've gone to Quebec.
Are you expecting Quebec to attract international attention as well? I wonder how much the geopolitical environment currently affects the strategic interests in large-scale Canadian iron ore projects, especially in jurisdictions like the north of Quebec.
I think so, not because necessarily that Quebec is a tier 1 jurisdiction. I mean, that would factor into their decision, but I think it's about de-risking for them as well. If Canada's I would say an allied country to most, and you don't have to navigate through straits and canals that may be subject to conflict, then they're subject to conflict right now. And so if they want to look for an area that is easily accessible, where they go into the bay and access our product, I think that's an area where they would thrive. Now, I think one challenge could be that, Prime Minister Carney has had an impetus with emphasizing keeping its resources in country and accelerating the development of those minerals. But he is not against doing trade with allied countries, of course, and to the extent that it makes sense.
Speaking of infrastructure, are we expecting the government to step in and help with the infrastructure, construction, development, or at least subsidize part of it?
That's what we would want, and that's what policy is dictating at the moment federally, where they are applying funds of billions of dollars to assist with critical minerals related infrastructure or resource development infrastructure. There's one federally called the Canada Growth Fund that helps and it deals with certain criteria, and you can meet one of those criteria and they'll support. And Foran Mining has their flagship project in Macoveni Bay that just went into production, has had a significant investment from Canada Growth Fund because they've got some critical minerals being developed. It's a polymetallic mine in Saskatchewan. They've just been acquired by Eldorado Gold, but that's one recent example of them putting their money where their mouth is. We have been speaking with government at various levels, and we've started the relationship to see how they can help either with acceleration of permitting or participating in some of the funding. We would like to have that support. And I would also say that Prime Minister Carney, one of the things he said is about, he wants to protect the north and protect our port areas and have more ports built in terms of having more access into areas of the country. And we're a perfect fit. We fit all the tailwinds of policy at the moment. So I think there's a very good chance that we've got to go there. I can't guarantee it, but we're taking all the steps we can to progress that. The other thing I'll say, Prime Minister Carney, he's a businessman. He understands economic development and the importance of it for the health of his country. He actually used to be a banker at Goldman Sachs and actually covered Stephen at the turn of the century when he was president of tech. So I think that's a good thing.
Well, speaking of the business environment, capital raising is important for any company in the mining industry. Given today's financing environment, would you be looking at a strategic partnership, a sovereign investor perhaps, or partnership with a steel company or major mining company? What makes most sense to you going forward?
Thank you for the question. It would be typically in the iron ore space, you do get a strategic investor in play. And the reason for that is we're not like gold where you can, when miners produce gold, when gold producers produce gold, it's gold is gold is gold. It's at 99.9% purity and it's sold into an open market. With iron ore mines, every product is different in terms of purity and impurity level. And given, again, I come back to the ever-growing scarcity of the high purity iron ore product, you have groups that want to secure access, exclusive access to that product. So what tends to happen in iron ore projects is a major will come in. It could be an infrastructure fund, David. It could be a steel company. It could be another iron ore producer, for example, or it could be a trader. And they will come in and they'll invest a certain amount of money for ownership in the asset and the commensurate offtake, because that's what they really want, is the exclusive right to that product, which is not infinite in supply. That is what we would look for as well. And we are talking to strategic partners. We're looking at geographically, we're looking at areas that make sense to us, if not in Canada. Those who are mandated to procure green steel, and some of the countries that are, I'm not saying we're talking to them, but geographically, the ones that make sense for various reasons include Japan because they're mandated to procure the material. They've invested in our friends in Champion, India, for the fact that they've just mined out all the good stuff and they have low grade material left, and they'll become 40% net importers in the next 5 years. I look at Germany and France, who have led the way in Europe to move to the green steel movement. They were supposed to be supported by government with the CBAM, which is an adjustment mechanism, and it hasn't worked, but it will correct itself. And just keep in mind, our production profile relative to the steel production in those countries equates to about 2 to 3%. So not a lot of production needs to be displaced for us to get into that market, which is, I would say, our shortest stop in terms of sending material on a ship. And the Middle East, with their infrastructure demands in the medium term, they have specific infrastructure funds that are mandated to go and procure this sort of material.
Would you have a type of partner that would more align with the strategic vision of Oceanic in mind? For example, a major miner or a steel producer, which of these would you prefer?
I don't think we have a preference. I think that as long as they are a sensible and educated partner, because the other thing we were doing, David, and we'll talk about what Oceanic's doing over the next 12 months. We have a pre-feasibility study coming out in the fourth quarter. It's a catalyst coming up, but we're not over-engineering the asset yet, because what happens is after you get into a strategic arrangement, the buyer of that product will likely want, and we would want for them to have input on the production profile, on the purity level, on the impurity level. So, they just need to be switched on about the product that they want. We need to be able to work cohesively together. So that's very, very important. And also from a community perspective, has to be a group that, although they may not have a majority ownership, this partner agrees and aligns with our values on community and working together with the local community in Opaluk and its surrounding communities as it relates to the development of this asset and protecting the nature and environment of their communities.
Just one more point on the government. So speaking of the government's investments into infrastructure, Carney announced the Canada Strong Fund. It's going to be Canada's first national sovereign wealth fund. He likened this to Norway's sovereign wealth fund, the largest in the world. Yep. What do they have in common? Both Norway and Canada are resource rich, with Canada being focused more on natural resources, metals, ores, lumber. Norway is exclusively focused on oil production. Now, what do you expect this fund to look like?
I think it's one that's heavily invested in infrastructure in the country. I don't think he's made any bones about it. There's no secrets there. He wants to secure the ability to develop the country and improve the strength and the financial health of the country. So I think it's literally that.
Okay, the major milestones of your company. You alluded to this earlier. You have a pre-feasibility coming up, right? And what can we expect to look forward to in the next 24 to 48 months as major milestones for Oceanic?
So people need to remember that we are very much an undervalued stock. As we said before, we've had to take a strategic break from being active in the market for market-related reasons, but now we've come back. We are trading at a 0.1 multiple to NAV, which is, for us, undervalued, with bringing the PFS up to front, with trying to secure a strategic investment. Of course, I can't control the timing of that, but we'd like to do that in the near to medium term. And we're de-risking the permitting aspect because we're progressing in earnest with permitting, environmental baseline work, impact assessments, et cetera, all the typical things. We do have an LOI in place with our community partners, and we will progress on that into an IBA. We're growing the team because, we've come out of a strategic hibernation. People also have to remember, we've drilled out a significant amount. We have a resource. Once the PFS is done, it'll be upgraded to a reserve. The resource is 1.4 billion tons. There is an enormous amount of resource that we haven't reported either in the other project areas or at extension or at depth with our current project, Hopes Advance. David, the current study, which is our PEA from 2019, has a 28-year mine life. This thing will be multi-generational. People have to realize that it's not complicated to process. It can be done for years and years and years on end. We will add resources when the time is right, officially and in a technical report. But they need to know that we are more progressed than your typical 0.1 of NAV exploration company. We're not an exploration company anymore. We're off to development. And when you see these Catalyst news releases come out, you should see, I would hope, a re-rating in the stock closer where you would see your developers, whether it's 0.3 to 0.5 NAV, for example.
Well, this is your stock. And you're just focusing on the last 2 years. What happened in July 2025? Went from 20 cents to, go ahead.
Sorry, David. We hibernated for quite a while. From 2013 to 2018, that was the period where the iron ore price was stuck at anywhere from 30 to 50 bucks a ton for the reasons I mentioned. When it recovered, we did that PEA in 2019, but we had to hold off a little longer because your natural customer back in 2019 was China. And our biggest shareholder at the time was a Chinese group that owned 22%. And the trade relationship between China and Canada went down the tubes in 2019. And that was a very public thing. And I think it will fall under Carney, but we didn't know that at the time. And we knew we had to move on. 2022 to 2025, you started to see again that shift in the demand for iron ore outside of China and in various in voluminous quantities, I should say, from other countries. And we say, great, we have other strategic partner options. It's time to come back. But we couldn't do that until we convinced our Chinese shareholders to sell their position, because Canada, and again, that's very public, they weren't supporting projects that had significant Chinese ownership. So it happened in 25 where it took a really long time, but we finally got them to sell down their position. It happened in July, August of last year. So that's what happened.
What would you consider as a success story for FEO, Oceanic Iron Ore Corp? Let's say we were to do this again in 5 years, and you look back the last 5 years, I accomplished XYZ, hit all these milestones, and I've definitely considered this a success. What would those XYZ points be?
Our metrics of success resonate through all the projects we've been a part of. If you look at Stephen, and I looked at Stephen and the team that he has built over the years, and I'm just a mere part of that. But with Atlantic Gold and Artemis Gold, we're not just individuals and management teams that are with talking to people like you, David, and promoting the story and having someone else operate it. Stephen is a leader of a team that builds and operates. We have a proven track record of that. He's done that several times where he's grown companies from a few million to a few billion, and it's just eventuated into a sale of the company. Atlantic Gold, returned 1,100% to shareholders. Artemis Gold started at 90 cents and it trades anywhere, depending on where the gold price goes, from 30 to 40 bucks a share now. And that's based on the team that he builds, his leadership. And again, coming back to the keys to success around de-risking, being in certain jurisdictions, having cost advantages, those are the hallmarks of success. So for us, success is strategic partnership with a experienced strategic partner. It is getting this asset permitted and built in that time frame, and the ultimate, obviously, re-rating that we would get from it, and economic development for the community and for the province. And people ask me personally why I do what I do in the mining space, whether they're in mining or not. It's great to be successful at what you do and build a project and take something from basically a story and a PowerPoint deck to what it becomes. But if I can be a small sliver in economic development for a community, and Stephen would echo those thoughts because they are part of his DNA, that is success to us.
You kept mentioning this is an undervalued project. Based on what metric, Chris?
Based on the fact that we're trading at 0.1 PNAV, and for our stage of development, we should be much higher. It's hard to look at comparables in the single asset iron ore development space because there are very few of them, or they're in a different stage than us. But if you look at, and if you talk to analysts, they'll equate a range of 0.3 to 0.5 PNAV multiple for companies that are in our stage of development. And if people don't believe that, then we'll get there very soon. So that's where the value gap is, and the opportunity is for anybody listening today wanting to get in now.
Okay. And who are your primary strategic investors right now? Your biggest ones?
Yeah. So one name I haven't mentioned, and I should have. Frank Justra is the second largest shareholder. I don't know that I need to introduce and provide a bio for Frank, but for those who don't know, Frank is in the Canadian Mining Hall of Fame. He's the founder of Goldcorp. He's the founder of Wheaton. I don't think I need to say any more than that, but he's grown dozens of companies from nothing into success stories. So he's our second largest shareholder. Ryan Beatty is the largest shareholder of the company, he is a longtime business partner of Stephen Dean, and he is also the largest shareholder of Artemis Gold, was the largest shareholder of Atlantic Gold. His background, his core business is in the real estate development space in retail and industrial in Western Canada. He's probably the top 20th wealthiest people in Canada as well, but an incredibly smart individual and connected individual. So he's been a great partner for us and supporting us whenever we've needed it. And also, I've mentioned there was a period we were in strategic hibernation. Those are the two people among management that have continued to financially support this company until a better time. So those are the partners you want. And I can tell you, David, Stephen Dean, Ryan Beatty, Frank Justra do not hang around a stock for a 12-year hibernation period if they don't think it's going to be a success. And for the reasons I've stated many times over, it will bear fruit.
And tell us a little bit about your professional background. Coming from, you were actually in finance and accounting. Am I correct? That was your background?
I have a chartered accountant designation, Oracle, a Big Four firm, and left in 2011 for the mining industry. It's been with Stephen ever since. It's been within this office space. And it actually started with Oceanic because that's when we acquired the asset in 2011. Frank actually acquired the asset, I will say. And we were the management team for it. And so I've been with Stephen and his team through Oceanic and Atlantic and Artemis. I was CFO for those other companies. So this is my first stint as CEO under Stephen's mentorship and guidance. And it's very much still Stephen's vision, and he's very much involved. Stephen has, since he was the CEO of Artemis Gold, he's now no longer the CEO, but he's very much the executive chairman and involved. But part of that is so he can dedicate more time and focus to Oceanic and seeing this vision through as all these tailwinds have seemed to come together for our project.
Well, thank you very much. Tell us where we can find more information about Oceanic Iron Ore.
So oceanicironore.com is the website. We've also established a LinkedIn page for Oceanic Iron Ore, and you'll also see more or less nothing more than Oceanic news under my own personal LinkedIn profile, and we have an X account as well.
Okay, we'll put the links down below, so make sure to follow Chris there. Thank you very much, Chris. Pleasure to have you on the show, and look forward to more of your success. Take care for now.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.